Hi, and welcome to Random Rogers Big Picture for the week of August 26th. Four quick things on the agenda this week, and I'm just going to go through them boom, 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 boom. Just jump right into it. First is, on the network, there was a whole lot of chatter about the R word, and questioning whether or not we're going to have a recession. The tipping point for this question being asked over and over was comments made by Angelo Mazzillo. Pretty tough for most folks to predict a recession, clearly. And I'm certainly not doing that as far as it happening right here, right now, but we're in an economic cycle that will end, and when it ends, there will be a recession. Tough to say exactly when that would be. I would think that we're not that far away from it, but the important point, regardless of when it comes, is I doubt that we're going to see a whole bunch of people saying, oh yeah, recession's right around the corner, here it comes. It's the type of thing where people don't really see coming for some reason, or at least they don't say they see it coming, very rarely. There's a few exceptions, of course, but in general, if you're one who does watch the TV or do a lot of reading, depending on where you do your reading, you probably will see a whole lot more commentary before the next one, whenever that is, that says no recession. So be careful with that one. The consensus is very likely to be wrong. Next up, about the market. Well, we had a pretty good day on Friday, up a little over, I think it was 1.15% for the S&P 500. The market is snapping back pretty well. And this is something I wrote about a bunch of times. I wrote about it during the sell-off in late February, early March. And, I say this in every video. No analysis, just normal behavior for fast declines. They snap back fast, and then after that, what happens? We'll see. That really is the variable. But and this is kind of something I've said before, but without my being able to quantify how big the subprime issue is, if it was as big as so many people feared, it makes sense to think that there could be further for the market to fall. There are some comments that have come in that are fairly pessimistic, and maybe they're right, I don't know, or maybe they're wrong. Again, I don't know. But I wouldn't get too hung up on the gloom of it or the joy of it. Realize that this is something that was kind of a big event. Maybe it's a huge event, but big enough to warrant the Fed taking action in a very quick manner, seemingly out of the chute, an effective manner, but we don't know for sure yet. It makes sense to expect there'll be another leg down. We may go back, take back another 30 S&P points before that happens, or more. I don't know. The point of this is not, to trade around that. Readers who do like to trade this sort of thing, well, they've been leaving comments, coming in and going out, and, you can follow them if you're so inclined. Not the trade I'm going to make, but the point is that you should expect there emotionally to be some more declines that go with this whole subprime liquidity crisis, subprime crisis, credit crunch. Am I leaving any names out? Okay, next up, Rita left a comment on the blog that I thought really was kind of a rough comment. He says someone left a comment about some trade they had done, or talking about having bought into the fear, which obviously right here, right now, looks pretty damn good. But this person said, you are lucky because you technically should have lost money that you risk. I am still negative on the year like everyone else. I don't know exactly why the other reader should have technically lost the money. I don't understand that. But he says he is still negative on the year like everyone else. And that's kind of what I want to address. The S&P 500 closed at, believe it, 1479, if I'm right. That's like 62 points or 61 S&P points. So that's, better than 4% on the year. Not everyone else is down. If you are down, I'd be curious, please leave a comment on the blog. Maybe we can kind of do a poll thing. Are you down on the year? Feel free to leave a comment. Are you up on the year? Feel free to leave a comment. You don't have to go into great detail, but with the S&P up 4%, the only way I can think that someone is down is real big bets, way too much in small cap, which is in itself a big bet, bad luck, or they just really are doing something wrong and they need to revisit what it is they're doing. I'm not sure which. I don't know the person. I have no idea why he's down, but it just doesn't make sense. I mean, if you see a lot of the mutual fund guys coming on the tube or getting interviewed on the internet, they're all up for the year. Plenty of them are lagging the S&P a little bit, but they seem to mostly be up. If you're someone, and I take that this person is, who manages their own portfolio, if you've made the decision to manage your own portfolio, you must feel that a professional manager must not be able to add value, which is reasonable if you think that, and depending on who you are, you might be right relative to what you could do. A professional may not be able to add value, and that is fine, but it really is tough to be down on the other. This is a fine year. We had a tiny little dip. We had an even smaller dip a couple of months ago. This is all normal, down a little stuff that we've been missing for a long time. And, being down, I suppose it's possible maybe I'm being unreasonable, but I'd be curious to see what everyone else's experience is with this. Last item, sentiment. Reader Tom K. emailed me some stuff that I believe is from Jason Gepfert about sentiment readings. Basically, sentiment is puking down, or has puked down, and now is kind of turning up. Tom asked me to weigh in on it. This is not my strong suit. I'm going to disclose that very candidly. I am not good at this sort of thing. I'm sure some troll will say I'm not good at anything, which is fine. But the one chart on here, and I can't publish them because they are proprietary, copyright something or other, and I'm just not going to mess with that. But on the one chart, he's got an overlay of two moving averages, a faster moving average and a slightly slower. I'm guessing, although I'm not quite making it out, that it's a 10-day and a 20-day, and the 10-day is pointed up, headed toward the 20-day, and maybe with today's action overtook it. Those types of, that's the radio going off when someone uses the repeater, it makes that Morse code sound. I'm going to say that short-term momentum things like 10-day crossing over a 20-day, or shorter crossing over a longer or slower moving the average, that generally is a sign of an upturn. I've seen that work time and again. I first heard about that in the early 90s, and it works an awful lot of the time. It's not something that I rely on too much because it doesn't have to work. It can be wrong, and since I'm more of a fundamental person than technical, to me this is much more hardcore technical than what I do. It's not something that I necessarily focus on, but people absolutely do have success using this sort of sentiment stuff, this sort of fast moving average related to a slow moving average. This is absolutely valid, but it's not right for everyone, and it's something that for now I'm not using, but based on the charts here that Gepfert has captured, it's pretty damn compelling. I will say that. It seems to work over and over, but it's really not much of it. That's not a great answer to Tom's question, but probably the best I can do. Have a great weekend.